Good afternoon, everybody. Today is Wednesday, the 22nd of September 2010, and now we're live. Okay, it's Wednesday, September 22nd, and we are live here, I do believe. And yes, we are. Okay, so the market was down a little bit today, down 56 cents from the SPY, and still holding, though, above the important prior resistance level. So until we start breaking at least some prior resistance levels and close below it, we still want to give the benefit of the doubt to the buyers. However, as I said in this morning's commentary, we do, give the benefit of the doubt here, but we still have to have some reason for doubt, only because we've seen this market have such a prolonged and really nice rally here. We're right on the trend line. We're right on the 5-day moving average. But this 30-minute time frame, I think, really represents where we can see some of these key levels really most efficiently. That is, we look at the prior resistance here at about 113.20, and we basically came down and tested that today and held up. I think a lot of people were looking for the market to really break down and die, but typically it's a slower process here where everyone's looking for the top at once, that it's not going to generally occur that way. And when you look at the daily time frame, we still have this prior resistance holding as support on the bigger level as well. So we're at an important area here. We've come pretty far pretty fast, and it makes a lot of sense to kind of just take your take some profits and be defensive in here. Looking at the 1 minute time frame, I was pointing out in our chat room today that this was really, for me, the best trade of the day. After that I decided, which was to get short here in the SPY. After that I decided that I thought it was most likely going to be a very choppy day because I was looking for a test of the prior resistance, and when that was tested and we saw it hit in there, I was looking for it to become support and hold for the day, but I didn't think we would get a rally. And you can see in here that this actually, this area from the last 3 days, where we had this prior resistance on Monday, support on Tuesday, and support this morning, did become resistance at 113.75. So 113.75 is our near-term level of resistance to keep an eye on in the SPY. Above that, we look at the daily time frame, and we can see that we basically made it up to that next level, which is just about 115, and then above that we have really about 118. So if the market can kind of regroup and surge higher, 115 is the biggest level of near-term potential resistance, and above that, intermediate term, we have the 118 level. So back to the 30-minute time frame, what we're seeing here is the 10-minute time frame. We're seeing a little bit of indecision after a big rally. We have to be aware that some of the other groups are getting a little bit weak, and we have to be concerned or alert to the possibility that from a failed breakout can come a fast move lower. If you recall, what we've been observing a lot in this market is, we've seen the death cross, and that led to a huge rally, and we've never seen those lows since that death cross again. We also had, the real talk of the Hindenburg omen over in here. That led to a little bit of weakness the next week, but then we really turned around. So now when things are supposedly looking bullish and we break the neckline of the inverted head and shoulders pattern, I'll be first to admit I've been pointing this out and the development of it, but what I don't want to do is take this literally. Instead, what we want to say is, we've got this inverted head and shoulders pattern, and a textbook will tell you that the height of the pattern added to the breakout point would give you a price objective. So we just take the height of that and add that line, and that would tell us that this market was going to 125. I think you have to be a fool to just kind of accept that blindly because of a pattern. It's something to be aware of, but what's more important than price targets and that sort of thing is risk management and understanding where support and resistance levels are that are important to the market. So obviously 113, we could just call it 113 even, just give it a little bit of room down there, but 113 is an important level. If we break below that and hold below it, that will put us below the 5-day moving average, and then we would say intermediate term that we would be expecting for a little bit deeper retracement, perhaps down towards the 112 level. That doesn't mean it would fail completely, but from a lot of failed breakdowns and breakouts, we see fast moves. One group that has been real strong recently is the IYR. This was again, as what everyone referred to beginning of last year, that is beginning of 2009, as the second shoe to drop. Well, the IYR we had seen had broken to new highs here on the weekly time frame, and now we've kind of popped back into that range. Where'd my other daily go? Oh, here it is. But we had popped back into that range, so we have to be really alert in the IYR, especially that from this failed breakout, maybe it's too early to call it completely failed, but if we break some support levels, then we could see maybe a fast move down even towards the 50-day moving average. So the IYR, I would think that you would want to keep a close eye on the action in there. It's kind of led us on the way up, and this market broke back down below that prior resistance, which would be similar to what we are looking at as far as 113 on the SPY. So the Russell, I'm sorry, I call it the Russell sometimes by accident, but the IYR 5350 I think is an important level, and we are below a declining 5-day moving average here. So if we break this support, then I think the IYR could probably indicate to us that we're likely going to be heading lower. So we're below a declining 5-day moving average in the IYR, and that's definitely a reason for concern, as is the action in the financials, which had gotten up to and briefly, or I think one day, closed above that, and it did yesterday, I guess it did, right at that 200-day moving average that some people look at as a magic number. It's not, of course. It's just a visual reference point, but it hadn't broken the bigger level of resistance up here at about $15.10. This market could be coming back down to reload, but right now, the intermediate term, we are below a declining 5-day moving average. We've seen that 1460 level that we've been talking about as support, which was prior resistance, now acting as resistance again. So, if these financials, if they stay trapped under the declining 5-day moving average, right now on the intermediate term, I say that these things are guilty till proven innocent. You don't want to be a buyer with a declining 5-day moving average. On the SPY, it's more neutral. So the odds don't favor a big direction, a big movement in either direction right now. For the NASDAQ, we've had a hell of a rally here, and right up to these prior highs is where we're finding resistance after the flash crash recovery, basically, knee-jerk recovery, recovery. That's where we're finding some supply right now at about 48.80 on a closing basis. And the bigger levels, if we're going to pull back from here, I would think that an important area is this $47.60 level. It's approximately where we have the 10-day moving average as well. But on the NASDAQ, we do see a healthier pattern here. That is, we have higher highs and higher lows still above that rising 5-day moving average, but the rate of ascent is slowing here, and that's why we're breaking that trend line. So near-term support, really, we tested it today at about $48.40. That is $48.40, and if we break below that, well, then then we'll be below the 5-day moving average as well. And then we want to look at some of these other levels, such as this prior resistance from Friday afternoon at 48.10 and 47.80, and on down from there towards about 47.50, which is an important level as well. So the NASDAQ, it's extended, it's been extended, but we're starting to see, a little bit more volume up in here. Big volume without further upside typically means, distribution. We don't have the market breaking down yet, though, so to me, aggressive shorts don't make sense. As I said yesterday, to buy a little bit of an inverse ETF in this area to hedge against long positions that you're reluctant to let go of, or that you haven't been stopped out of. As a hedge, I think it makes sense, but as a speculative breakdown, so far it doesn't make sense. The Russell 2000 got up to its, we're close enough to call it, testing that 68 level. We do still have a pattern of higher highs and higher lows, on this daily time frame, if you look at it like this. and we are holding above a 10, 20, and 50-day moving average. When we go down to the 30-minute time frame, what we see here, though, is kind of the same thing as the SPY. This is, kind of the equivalent of SPY 113, whereas 65.50-ish right now, we're holding above it. But if you look at that orange 5-day moving average, the 5-day moving average, let's drill down to the 10-minute time frame to get a closer look. We're testing this prior resistance. 5-day moving average turning lower, so I would look at near term maybe 66.20ish would likely be first resistance, then 66.65. So if we get up through there, and then these are levels where we're likely to encounter resistance if we're just kind of undergoing some distribution. If we stay trapped below the declining 5-day moving, below the 5-day moving average, it begins to decline, then I would be looking for probably a pretty quick move towards 64.50 as people kind of scramble to lock in the profits, and then we would see how how the market reacts from there, from the 64.50 level. But the next bigger level below that obviously would be down near about $63 a share, and this market has been nicely stair-stepping higher. The semiconductors are another group that gives us reason for concern. As we know, they have gotten up to that. Last week I was calling that 50-day moving average a magnet, and it did get sucked right up to it, and that level was also the area of prior support. So it makes sense that we would encounter some supply in here. It doesn't mean it's going to just completely die in this area, but at least maybe this market's reloading for another long. But you don't get involved right now while it's pulling back and it's below this declining 5-day moving average. The point I want to make about that is, we've been talking, someone asked me, well, Humana is a stock that we had gotten along, that is Alpha Trends, or in here, and gotten out right in there. We were watching it for a pullback. Someone asked me last week, does it look good? It was at the 10-day moving average. I said, well, it's coming down on bigger volume. You don't want to buy it as it's declining, as it's showing these lower highs and lower lows. We don't want to be a buyer of it. Instead, we want to wait for it to start to turn sideways and then to recapture that 5-day moving average and turn higher. So this morning I had this as a watch list idea for Alpha Trends, that if it got back above 51.50, we would give it a shot, maybe with a stop down below this level. Well, instead, the stock just kept declining. And again, it shows that even just some stability, what appears to be stage 1 accumulation after a stage 4 decline, doesn't necessarily mean that the market will in fact turn back to the upside. So we want to participate in stage 2. When we have a daily uptrend, well, we shrink it down a shorter term time frame. We want to participate in stage 2 uptrends. Exit stage 3 if the daily time frame is higher, avoid the stage 4 decline, and start to plan our trades within that stage 1 accumulation. It doesn't mean it's a bad call to look at it in here, because obviously when it gaps lower, it makes a lower low. What we're trying to do is to buy trend alignment when it makes a higher high in there. A stock that was set up very similarly today was ARCC. This was on our watch list as well. We're looking at ARCC as here, this prior resistance looked like it was holding a support. We shrink it down to a short-term time frame. It got back above this moving average. If it was going to take out some resistance, we were going to get long with a stock here, stop rather. Instead, it declined. So right now, when you look at this market, there's going to be people who are calling this thing overdone, overcooked, I would call it kind of in a danger area because of things like the IYR. And I would say that we want to be, very cautious in here. I always say we should be cautious because risk management is job number 1. But, we've come pretty far, pretty fast. It doesn't mean it's the end of the rally. Perhaps we just need to refresh for a while. So lower your expectations. Over the last 2-3 weeks, things have gotten easy. Don't let your confidence exceed your ability and think that, you've got it all figured out now and that sort of thing, because that's not the way it works. I have some requests from subscribers who wanted me to look at some stocks, such as Salesforce.com. Salesforce is in a great uptrend on the daily time frame. It consolidates and it runs. Now, when we look at the 10-minute time frame, let's look at a 30-minute time frame. We can see it, breaks above that 5-day moving average, higher highs, higher lows. Stage 3 distribution, stage 4 decline. stage 1 accumulation, stage 2 markup. Now we're back to kind of looking like a failed breakout here. So I think that Salesforce is really starting to intermediate term turn a little bit more neutral. It's had a hell of a rally. I definitely wouldn't be getting short a stock with this kind of momentum, but it needs to heal a little bit before I would consider it a long as well. Coeur d'Alene, CDE, one of the miners, which kind of reminds me that I did want to talk about the GDX as well. But Coeur d'Alene, beautiful uptrend above a rising 10-day moving average. It's just a real steady pattern of higher highs and higher lows in here. And I think the name of the game in here is managing risk and setting stops underneath these higher lows, whichever one is most comfortable for you personally. So we've got a stock that's arguably extended a little bit in here. It's up a bunch of days in a row. Doesn't mean it can't keep continuing up towards maybe 20 and a half, but I would think that the name of the game is here to protect profits. But let's take a look at the GDX, because the GDX is we had been talking about this resistance level and then calling this a handle with a cup last week instead of a cup and handle, and who cares what you call them, right? But it broke the resistance. Now it's up here, and the GDX is on a weekly basis, if it's the close here, it's closing at an all-time high. Intraday, this high today was 56.67, and this intraday was 56.87. So the GDX hasn't broken to new highs, but yesterday certainly it turned around after the Federal Reserve. They were looking kind of like, well, they weren't going to quite make it in the morning, and then they rocketed higher. They gapped up today. So I think it's important. We want to see that this 55.5 area begins to act as support, and as long as 55.5 acts as support, I think you want to look at a lot of these gold mining stocks as stocks that could likely continue higher. Stocks like SLW, which is one that I wanted to talk about, I'm sorry, not SLW. I was more interested in SWC. But Silver Wheaton, just a real nice pattern of higher highs and higher lows. It's just stair-stepping higher. It's in a great uptrend. There's, you have to look at it and say, yesterday was probably a shakeout in here, and now it's recovered. I would be looking for support near 25.5. Let's see, take a look at MGM as well. MGM, I think a lot of people are trying to play MGM based on the strength in Las Vegas Sands. And if you're interested in a strong casino, you should be buying Las Vegas Sands, not looking at the one that hasn't moved. But it's getting a little bit more bullish looking. We've had some bigger volume here on that 1 day advance, at least lighter volume on the consolidation. Here's where we are basically right now too. We're still seeing this 11 has kind of been a pivotal level for the stock over the last 4 or 5 months, and maybe MG or LVS can drag it higher. It broke that 10.5 area. It's pulled back, but it's on the 10-minute time frame showing lower highs and lower lows. So if it stabilizes in here and then maybe above 1075-ish or so, I think that would be where MGM could go. And someone's asking about Adobe, and Adobe is just simply broken. I would just stay away from it. I don't even suggest looking at it after it does this. So I am not the right person to ask about a stock like that, because I avoid them. I don't look at them. I've been burned on that type of stock in the past trying to buy them, so I don't see any reason to be involved, Abe. Let's take a look here also. The edges of the display are cut off, so I guess I should have maybe looked at this a little bit earlier, but I apologize for that. Let me see if that fixed it here. And that's a bummer, because now I'm seeing what you guys are seeing, and I didn't have it sized properly. So I wish I had seen that message earlier. Stagehand Trader, thanks for pointing it out. Radio Caesar as well. And Going Mackay, who always has a question for me to take a look at, which is MHS. MHS is still in a downtrend. It's got a declining 50-day moving average. I would not trust MHS. It's a broken stock. It's recovering. If they don't scare you out, it's probably going to wear you out as it turns back down here. Thanks, Chart Diva. Always good to see your comments. I appreciate them. And looks like that will do it then as far as the questions go. So let's wrap it up here. And, parting words I would say is that we're in a potentially pivotal area, but the evidence of a breakdown aren't there yet. However, there are definitely warning signs, so listen to them.